data is really the new asset for a lot of these companies. So if you see a unicorn growing, it doesn't mean that they don't have IP, just don't have patents. But they have the underlying technology, which is part of the IP. So data and those kind of soft assets, we don't have strong protections for that. And that's where a lot of the value is.
Hello, I'm Bruce Berman, the host of Understanding IP Matters, a podcast series that looks at how IP rights affect creators and impact businesses. Thank you, listeners, for making seasons 1 and 2 a success. Understanding IP Matters episodes are available wherever podcasts are streamed and on understandingip.org. There are many ways to be an intellectual property investor. Today, we will look at a few of them. The first of our 2 guests is Efrat Kaznick, president of Foresight Valuation Group, a Silicon Valley-based intellectual property consulting firm. She works with a range of clients from Fortune 100 companies to startups in support of valuation, licensing, and mergers and acquisitions. Efrat has been a co-founder, CFO, or board member of several startups and is an active mentor and advisor in the startup community. Companies she works with are in the U.S., Europe, and Israel. Efrat teaches MBA and executive education students at Stanford's Graduate School of Business. Our second guest is Adam Gill, a founder and managing director at Chicago-based GLS Capital. He heads patent-related investments and sits on the firm's investment and valuation committees. He has evaluated thousands of patent opportunities and underwritten and managed hundreds of millions of dollars of litigation finance. Previously, Adam was a partner in the patent litigation group at Kirkland & Ellis. Welcome, Efrat and Adam, to Understanding IP Matters. Thank you for joining us today from Palo Alto and Dallas. We're going to talk about IP investing today. It's a mystery to a lot of folk. 80% or more of the value of the S&P 500 companies is attributed to intangibles, largely intellectual property. Despite that, IP as an investment is not well known. Purchasing patents outright, that's an IP investment, or copyright, or a brand or trademark. But when you invest in a company that has a lot of technology or is known for technology, it's a brand, and it also has a lot of patents. Isn't that an IP investment as well? I don't think people see it that way.
I think that very much is a IP investment. That's not what our investment mandate is, but when you're talking about IP investment overall, I would certainly include that.
Absolutely. So a lot of my business is working either with the sellers or the buyers of IP, in my case, to value what is being acquired. But a lot of time buying a company is a short way into buying into a technology. There's largely, I think, 3 types of M&A deals. There's acqui-hires when you buy for people. There's technology acquisitions where you buy for the IP, and there's just corporate acquisitions where you buy the company also for the customers and the revenues that they have. There's pure technology acquisitions where you buy a company just for the technology. In that case, intellectual property rights would be very important. Sometimes you buy company for other reasons, and as a byproduct, you gain the IP.
It seems like IP investing is confusing to people. They don't even know they're an IP investor. Litigation finance, however, it has a mixed reputation, especially with regard to IP. Why do you think that is, Adam? Why do people think that funding litigation is a bad thing?
I would imagine that the people who think that funding patent litigation is a bad thing are people who have patent litigation, brought against them. I've been involved in litigation funding for about 10 years now, and the Chamber of Commerce is an opponent of litigation finance and has talked about various problems that it might cause. One of those we hear, and I think probably most pertinent to the IP world that you hear that people imagine is, funding suits without merit.
But you're pretty careful in what you fund.
We are extraordinarily careful. If we fund suits without merit, we will lose money, in my view, and we will not have good returns, and we'll have unhappy investors, and we'll be out of business.
What percentage of deals you see would you say you fund, roughly speaking?
Somewhere around 2%, probably a little bit less than 2%. It's very low. We have a particularly high bar, I think, at GLS Capital, for better or for worse. I came out of a firm, Kirkland & Ellis, that does a lot of high-end patent litigation, oftentimes on the defensive side. And so my view as I'm underwriting is that what we're going to face, or what our counterparties are going to face as litigants, are people that looked a lot like I looked when I was in private practice, which is our people who are very skillful at helping their clients avoid liability for patent infringement. And so we have to be right. The system, I think, in my view at least, is set up so that there are a lot of ways to be unsuccessful as a patent plaintiff. You have to run the table, basically, as a patent plaintiff in order to succeed in a case. And defendants know this. They have IPRs, they have pretrial motions, and you can get out from infringement, you can get out in claim construction, you can get out in validity, and then at the appeal level as well. So we are very careful because of that, because of the risk that we see. I'm just going to say this. The second thing I hear sometimes is that, and I can only speak for GLS Capital and then also what I've seen and experienced in litigation funding. But the second issue that I see that people are sometimes adverse to it, or defendants are adverse to litigation finance, is there's an imagined threat, at least imagined in my mind, that litigation funders are going to be behind the scenes saying, you can't take this settlement, we want more money, pushing that, people to be unreasonable, pushing values higher. In my experience, the opposite is usually true. When thinking about things like settlement, it's important to have a very sober mind when you're thinking about the risks that are involved in any case. So we find ourselves more often than not telling people that they should be reasonable about the risks that they face, rather than pushing the value up.
Is litigation funding for IP, is it net positive for innovation, or does it not have an impact?
I do think it's net positive. I think that we are an important part of the ecosystem, just like the ability we support the ability to enforce rights in IP, right? And I think a lot of potential defendants might not like the presence of litigation finance providers because
you level the playing field.
I think that's right. I believe we do. And sometimes, honestly, we work with companies that have resources, but they don't focus on this part of the business. For example, there's a publicized deal that we did with ASUS. They are the 5th largest PC manufacturer in the world. They certainly have the funds to pursue the program that they've turned over to us and a subsidiary of ours, but they recognize that we have particular expertise in this space. And so they've chosen to outsource it, if you will, for us. And so maybe we level the playing field in terms of skill and expertise there, but we certainly, in most cases, level the playing field, I think, in terms of resources, and also bring some sophistication to parties that are not regularly or maybe ever previously involved in patent litigation.
Efrat, you have a somewhat different approach to investing in IP. Your companies are of all sizes, but you work with a number of unicorns, billion-dollar valued companies. What do they see, and what do you see about them with regard to IP and investing in IP, especially patents?
So a lot of the work that I do, I kind of work across the board. So I also do litigation work, but on the startup side, a lot of it is focused on funding, because what startups are really care about at the end of the day is getting funding, getting to an exit. These are the two things. Are patents helping with that or not? That's a very complicated question. There's observations are showing that a lot of unicorns, especially in the software field, which most of them are, get to a unicorn status, get to an exit sometimes without any patents. Any patents, I mean, like less than 10 assets, which is some of the studies that we've done, and we keep following unicorns throughout their life cycle. Now, does that mean that patents are not important, or they as opposed to a unicorn from a biotech unicorn where you can't really, you cannot start a biotech company without patents. And I've been an expert on an M&A case. There was a biotech company, a subsidiary of Abbott, that was sold and that was acquired. Half the value hinged on the issuance of one patent. Now, this is something you will never see in a software company ever. But in a biotech company, you can see that. setting a milestone as a patent, I don't think is a good idea. It's kind of a recipe for litigation, but that was the situation there. So going back to the unicorns, why do unicorns have no patents is an interesting question. So if a unicorn came to me and say, do we need patents? What do you advise? And that's not usually the kind of, because I don't provide legal advice, but I'm coming from the valuation. So in terms of increasing your value, what I see in startups, I see a lot of times they are misguided. They either don't prioritize patents at all, usually coming down from the VCs that own them, that don't really understand, or that are unaware of the fact that there's patent litigation funding. So they think that they can never enforce their assets. Therefore, they shouldn't invest in that.
Unicorn is a company with minimum valuation of $1 billion. It's not nothing. They can afford to acquire patents and file for them.
Yeah, so they'll get to acquiring patents, but they don't prioritize. So they get to the $1 billion valuation without having patents. And then as we chatted before we started recording this, a lot of it is a life cycle question. So if you ask me, is it important? I would say eventually it will be important. If the Googles and the Facebooks of the world have taught us anything, and this is a lot of the case studies I share with my students at Stanford, eventually you wisen up to patents. There's a binge of acquisition or somebody is suing you, and eventually you realize that you have to catch up. So you started catching up by buying a lot, by starting to file, by buying companies that have patents. So this is where a lot of that defensively, right? You don't really need those patents for anything, but you kind of wanna kind of build your moat.
They certainly look good for an IPO. You want to see that you're somehow protected.
I can tell you about there's a bunch that have IPOs without patents at all. Nobody cares.
Well, I remember. I think it was Facebook or Twitter. I don't remember. I think it was Facebook. They bought, I think it was 1,000 patents from IBM for $30 million.
Yeah, there was an AOL acquisition there.
That's a good buy. Why bother with R&D if you can buy 1,000 patents from IBM for $30 million, which is nothing to them?
I think the answer is what you want the patents for, right? And so some companies that we see, they are pushing forward into difficult technical areas where they're innovating, and they should absolutely harvest that technology, especially if they're going to build their business around it. You can't acquire that because you're the person that developed it. You're the person that invented it. Somebody else probably won't have the patents on what you invented, hopefully. And so that can be very important in kind of building your moat, if you will, around your business. Google and Yahoo and these companies, Twitter, and these companies grow up. They've innovated certain things, but they're practicing a much broader scope. And so having larger portfolios then are able to protect them when they see competitors saying, you owe us money for this, or trying to block off certain spaces.
Efrat, is it make sense for these companies to wait for later in the life cycle to acquire the patents, or should they be thinking about buying patents or acquiring them earlier?
I think they should be thinking about filing them, not acquiring them. So I look, I'm not a lawyer, all right? So I've been around IP, but for what I know, best practices are you develop a patent portfolio with a roadmap. So some of it you file organically, some of it you buy. You don't necessarily have to file everything. Some things you end up needing and buying. But if your entire strategy hinges on, okay, I'll wait until I really need it and then I'll start buying in bulk, you end up with something that is not optimized for your business, I think. So from what I've seen, eventually your organic filings will catch up, and maybe 20 years later, you'll be where you need to be. But this is what I tell my students. I say, if you're Facebook and you have $1 billion because that's what they spent buying from AOL, and they were sued by Yahoo pre-IPO, and most of startups are not. And then you can find yourself completely derailed by a lawsuit. You can find yourself unable to raise your next round of funding, because the one thing VCs, they don't know much about patents, but they know when litigation is filed, this is not a good thing. So they're not going to support you building a portfolio. But if you are subject to litigation, it makes it very difficult to raise funding. And I started saying some companies that I see have too many patents. Like I see startups that come in with 200, 300 patents that filed in jurisdiction they never need to have patents. That's why I say misguided. You have to find kind of a clear middle of the road where you're not spending too much, but at the same time, you're not neglecting it entirely.
Is that somewhat industry dependent, or depending on the type of company?
100% industry dependent. If you are in heavy R&D industries, semiconductors, biotech, pharma, when you spend major dollars, there's not even a question about patenting. If you're in a software company, you can grow a software company with under $100 million to be a unicorn and sell it. And you can have very few patents and nobody's going to care unless somebody's really suing you and making your life miserable.
What other IP rights do they have or can they have that you've seen, if not patents?
A lot of them have brands. A lot of them have data. The problem with data is it's not protected by anything. It's not protected by patents. Data is really the new oil, whatever the saying is. And I've written about it for IAM extensively and for others. But data is really the new asset for a lot of these companies. So if you see a unicorn growing, it doesn't mean that they don't have IP, just don't have patents. But they have the underlying technology, which is part of the IP. They have trade secret protection, which is not very strong, as we know, because of people mobility, right? And cybersecurity attacks and all of that. So data and the people, those kind of soft assets we don't have strong protections for that. And that's where a lot of the value is.
And Adam, your clients and those you fund, is there a pattern there? Or they tend to be tech companies of a certain nature or a certain type? What are you seeing?
So we see requests for a decent number of software patent cases. We don't invest in a lot of software patent cases. We are happy to look at them, but the state of the law in what is called Section 101 or patent subject matter eligibility, there's a big gray area right now there. And our process is that at the end of our underwriting, we need to be able to tell the investment committee, which, as you mentioned, I'm a part, we believe there is a high likelihood that this case will win. And if you're in a gray area like Section 101, subject matter eligibility with a patent, you just can't make that statement. You can't get to a high probability unless you are way on the one end of the continuum, which sometimes we see very technical patents, software patents with the technical pieces built into the claims. Usually software patents we see don't have that, but some do, and we are happy to invest in those.
What's a less gray area that you see?
Semiconductors is an area that we like, right? It's right there.
And companies are still willing to take licenses from semiconductor creators or fabricators. It's not very much the case in other areas.
I think that's right. We still view the area with some skepticism just because it seems that no matter how much diligence we do, no matter how tied up the infringement case is, the validity case is, when our counterparties approach someone for a license, more than 9 times out of 10, the response is the same. We don't infringe. Even if we do, the patents are not valid. And even if they are, and we do infringe, it's not worth anything. And then, so as I say, there's a tool when we disagree, there's a tool to help us get closer in our understanding, and that's litigation. And so we see, I think the semiconductor space is more willing to discuss licensing than some other industries. I think you're right about that. But still, I think even with a pretty clear-cut case, you often are forced to litigate.
At the end of the day, patents is kind of the signal that the investors are looking for. So they don't really understand a lot of the other. Brand is another, and branding assets, things like trademarks and is another thing. But then you have to be in a very specific space where it matters. So going back to technology assets, people understand patents. At least it's something they can look up. For patents to be reliable, there has to be, and I think Adam was alluding to that, although he didn't say it like that, is there needs to be a very close relationship between the product and the patent. And this is where the software industry has strayed away from that. So the IP can be held in one place and the invention can be practiced in many other places. Not so for a biotech or a pharma company where there's one-to-one. They usually have less patents, but the patents are very focused on the product.
We do a decent amount of work in the pharmaceutical space, and I agree that they are more reliable. I think one of the big reasons for that is that in the pharmaceutical space, especially with respect to Hatch-Waxman litigation, you still have the ability to exclude your competitors using your patents. That's the default. That's remedy, right? That's what Hatch-Waxman litigation is about, whether a generic will be able to enter. And in that context, patents are very powerful. right? Because it truly is. You learn in law school, patents are the right to exclude. Well, in the United States, they're not. They're the right to bring a case for damages, typically. In the pharmaceutical industry, in Hatch-Waxman litigation, they still are the right to exclude. So you can have one patent that defends many billions of dollars of revenue annually, and they are very strong and they are reliable. They're also what they call the unpredictable arts. And so they're on balance more difficult to invalidate than patents in the electrical arts or mechanical arts. Going back to your question before, Bruce, you were searching, it seems, for reliability or certainty. How do you increase that? Or the flip side of the coin, how do you reduce your risk when you're talking about investing in patents? One thing I would say that stands out to me is that there's safety in numbers, right? If you go to a company and you have one claim charted patent and you go to a large technology company, you're almost, unless you're willing to take an incredibly low amount, if you want real money, you're going to have to litigate. That's the default. If I was working for that company, I would probably say the same thing. We have a lot of attempts to try to avoid liability through trying to show that we don't infringe, getting a claim construction that's too narrow for this, or going to the patent office with IPR proceedings and trying to invalidate them where the numbers are on our side. And so why wouldn't you take a few of those attempts before you are ready to talk seriously? Because if you have one or two or three patents or one patent family to get around, your odds are much better. So I think companies, if they want to talk about licensing programs and licensing discussions as opposed to litigation programs and litigation discussions, should have more robust portfolios, not just of any patents, but of important patents that are, as Efrat said correctly, closely related to the products, right? Patents that you can chart on a product, patents that you've searched for prior art and you think that there is not invalidating prior art out there.
I would say, yeah, unicorn or no unicorn, depending on what's your business model. So if you're there to enforce, then you have to think about claim charts. But a lot of the work that I do involves future looking. So what I call it a carrot versus a stick. The stick doesn't work very well for startups as a business model. I mean, it might be something that is levied against them. But if you're the holder of the IP and you're a startup, you mostly have new patents in areas that don't have a lot of infringement as a rule. Otherwise, you wouldn't be a trailblazer startup out there in the world. So a lot of my work is actually more focused on licensing as the monetization, or making your own products as the monetization, as opposed to enforcement as the monetization. So there's a time and place for an enforcement model. And if you're a unicorn, if you're on the receiving end, and you are, a lot of them are on the receiving end of a lot of lawsuits, I think, the more, especially by incumbents, by the way, not so much by NPEs, but more so by incumbents. So a lot of lawsuits you see unicorns involved in are by, people who don't want to see them change the market. And those are companies that have a lot of IP.
What about valuing companies for mergers and acquisitions? Is that a different approach to valuation?
Well, I have a lot to say about that, but I'll try and boil it down to IP is not a driving force in the valuation of companies for acquisition. Usually, M&A deals are done based on a stock price value. So you do a valuation of the company based on the value of the stock. And then after the fact, you break the acquisition price into the various assets, an accounting exercise that is known as the purchase price allocation. Then and only then does the value of IP emerge separately. You can't really make it match, so you end up with something called goodwill, which is a big plug number that equates your identified assets, whether tangible or intangible, to the acquisition price. So, and I think there's been a lot written about it. I've participated in that, and I've been on panels and heard panels and people complaining there's not enough due diligence done on IP prior, not even to mention valuation, just pure due diligence, just looking at what the assets are. And there's a lot of horror stories about companies having acquired other companies with a lot of IP issues that were not surfaced because there was no due diligence. And if anything is diligence, it's the patents, because that's easy to diligence because you get a list and you kind of make sure that. But beyond that, unfortunately, I don't think, unless it's really an IP intensive industry, It's not very often that it's done as thoroughly as it needs to be, not to mention valuing the IP. Where I see a lot of IP valuation done for purposes of acquisition is by PE companies. I have a few clients that are PE, but yeah, usually they do it too late though. Usually a PE firm, I don't know, Adam, your experience, but you have your model where you kind of create a platform. So you roll companies in, and then you try to figure out, well, what can I do with this company? And if it happens to have patents, then and only then you start thinking about, well, can we get more out of this company if we monetize the IP? And that's after you've acquired it. And that's kind of a little late in the game to do that.
Sometimes we'll see divestiture in that regard. A lot of times, private equity companies that are still working with a company that has IP, or companies that they've rolled up that have IP, a lot of times they're focused on the revenue of the company, the sales, the organic business, and are not really wanting to start a lot of industry-wide fights because, as you know, they know kicking off patent litigation like that oftentimes results in retaliatory litigation, which gets expensive, and you have offsets. Most of the time where we see patents that are held by companies like that go into litigation is, if a company is falling on hard times, right? If a company, a unicorn gets an amazing valuation, and then let's say they have a great networking company, and then they're not able to compete at the scale of networking companies, box makers, and they fail. But they might have some very valuable IP. And so the investors kind of, as the company is being kind of wrapped up or trying to figure out what to do, a lot of times it's kind of like a last-ditch effort to recover the R&D dollars that have been spent on the company. Another one that we see quite often is highly innovative company working on a problem, develops a solution that other people have not been able to develop. A large technology company will say, "We hear you have this technology. We'd love to partner with you on it." And this is a great day for the company in their minds because they've made it, and this is validation. So they sign the NDA, the engineers come over, they look under the hood, and then the larger company says, "We've decided to go another way, or we've decided to not do this." And then in about 20% or 30% of the time it should take to make that product, the larger company comes out with the similar or the exact same product. And then the smaller company basically just has IP at that point because they're not able to compete with, not having a large partner and now competing with a giant in the business. We see that way too frequently. I'll know 3 minutes into the story exactly where it's going.
The whole area of bankruptcy that we don't have to talk about now, but that's a lot of where my work is also going sometimes is you see the assets at the end of the road, and it starts and ends in my mind with the really good lack of good valuation, whatever you want to call it. It's not that we don't have methods, it's that we don't have enough data comparables. So the problem is that there's no comps because there's no disclosure. Companies are not valuing their IP regularly on the books.
Sort of the opposite of real estate, where there are a lot of comparables and a lot of information.
Another thing I wanted to mention is not really, I don't want to call that, but you see these situations where Adam reminded me, they're coming into hard times. You see the activist investors taking over the board. I've been involved in a few of these cases. And the first thing they do is, well, one of the things, if the companies have patents, is they're trying to milk those patents as much as they can. And then you see all sorts of enforcement activities that never should have taken place. But just because there's a lot of pressure by these activists, they take off the board, they sometimes, fire the CEO, bring their own CEO. I mean, there's a bunch of them around. So you see those situations. So companies coming into hard times having patents can act in different ways, and depends on who's really controlling the company at that time.
We have time for just a couple of more questions, but one question I'd like to start to conclude with is, what would you tell investors today that they should know that perhaps they don't with regard to IP investing? And that could be mostly patent related, we're thinking, but IP in general. They seem to wait until there's something dire, litigation, bankruptcy. Now I have to get my arms around what this IP is. Why do they wait so long? Why can't they start that process earlier?
Probably happens because it's complex and it's expensive to do that work. right? When we talk about putting together claim charts and doing, analyses of validity and prosecuting patents, and all this is very expensive work that takes a lot of time. And so a lot of people will do it when they have to do it. Companies will do it when they need to do it. And so a lot of times it doesn't get done prospectively.
So I have this model, because this is something that I'm teaching and speaking. I'm also speaking to investor groups around Silicon Valley, if they'll hear me. They don't always want to listen to talk about it, but a lot of the angel groups are a little more open. The VCs are very arrogant, you can't tell them how to run their business. They know everything. So there's a difference between, so I'm talking about investing in startups now. There's a big difference between whether you're a debt investor or an equity investor. And if you put debt and equity on one side, and if you're an institutional investor like a VC or like a money manager investor, or if you are a company, a corporate venture. So if each of these quadrants prescribes a different approach to how in my mind, you should value the IP and look at the IP. Let's just talk about debt and equity just to keep it simple. If you're a debt investor, what you have no stake in the growth of the company. This is a fixed income investment. Your return is limited to interest, and all you care about is that they pay you back the loan plus interest. In that case, the collateral value for you care about liquidation value. You care about, if you have to take over the collateral, can you sell it? Can you sell it quickly, and what would you sell it for? As opposed to, if you're an equity investor, what you should care about, and a lot of them don't understand it, is what I call the pivot value of the IP. So would this IP help you grow, help the company grow? Because that's where you are growing with the company. And can you pivot on the IP, which is the most important question for a startup, because most of them don't have the same business model that started with. And the IP can be at the anchor that allows you to switch markets or enter a new market where you have something. So you're not completely without a shield, right? Entering into Microsoft territory. Not to mention being acquired at the end of the road. IP could help you in some cases. Two very different types of investors should care and value the IP in two very different ways. That doesn't always happen.
Last question. Where is IP investing going? Or where is investing going as it relates to IP?
I don't see large changes coming in the world of investing as it relates to IP. The system has subtle changes, sometimes not so subtle changes, but ultimately the world of business that generates all the IP and that ultimately, harvests the value from it, I think kind of interacts with it in much the same way, kind of fundamentally the same way.
You don't see licensing getting any easier than it is now.
I doubt it. I mean, there are always movements, right? Like, for example, now I think, cellular standard essential patents are having a good moment, right? Because they're enforceable, they're valuable. Some courts have said they're willing to set worldwide rates, so you don't have to litigate in every single country around the world in very inefficient ways to get the value. And so I think those have kind of risen up as valuable, and people holding those assets are feeling good about that. And so people will adjust to some extent. Companies will probably adjust, investing more that are developing technology related to standards in certain ways. I think when things happen, such as patents becoming less valuable or becoming more difficult to enforce, I think companies make subtle shifts, like maybe looking to protect through trade secrets in addition to patents or instead of patents.
Efrat, your final word?
My final word is, for me, it all comes to transparency and reporting. And I think we're not only are not coming closer to that, we're moving away from that. So now we have the accounting regulators have decided that things like digital assets, which I think, Bruce, you and I are very interested in, you can think about NFTs and tokens and even cryptocurrency, are going to be treated the same way as intangibles are treated, which means we have another group of invisible assets coming in. That is not great. So the status on the importance of patents is going to stay very industry specific unless there is some sort of a reform in the reporting and valuation, a regularity, or the cadence of valuation becomes more regular. And that's not going to happen without regulation.
IP is still going to remain an elusive asset. Thank you very much, both of you. Thank you for your time. I know it was hard to get this time for both of you, but this was very enlightening to me and I think to our listeners. Thanks again and have a great Happy New Year.
Thanks, Bruce. Thank you.
Thank you both.
Understanding IP Matters is brought to you by the Center for Intellectual Property Understanding, an independent nonprofit, and its supporters. Listen to episodes at understandingip.org or wherever you stream your podcasts. Follow SIPU on LinkedIn and Twitter. We welcome your comments and suggestions. Contact us at explore@understandingip.org. This episode was produced and edited by Nathan Tower with associate producer Aaron Devereaux at Nonsensible Productions. Content conveyed is for informational purposes only and does not reflect the views of SIPU or its affiliates.